It was eventually sold to Allergan for 2.1 billion. So a few years after that you had left. Did you ever feel like that you missed out on taking the company all the way?
Particularly. It was in great hands. The team that came in after me did a phenomenal job. Um, and I think, as the Brits like to say, I think you have to always remember horses for courses. Like there's some folks that are the right people at the right time in a company, and then there's other people that can build it out. Kythera was heading toward launch, commercial launch, and my heart really wasn't in that. We had done a large deal with Bayer for ex-US rights. We'd raised plenty of capital. The company was in great shape. It was time for the next group of leaders to kind of take it to the next level, which they did. Um, so, I made the same comment to every board I've been on, every CEO job I've had, that at some point I'm not the right CEO, and I'll be the first one to raise my hand and say, you need a different skill set. So I think in building and scaling a company, there's a certain type of individual that you need, a certain kind of team that you need. As you move to more of a steady state product launch mode, there's a kind of a different mindset, different skill set, different group of people who can take that to the next level. So I think there's sort of a natural evolution to companies. I'm sure you've seen this even more than I have, where founder CEOs stay too long in their roles. And so I think it's really important to understand what that transition looks like. And I'm going to use your word, awareness. It's really important to have that awareness as someone leading an organization.
Was acquired by Johnson & Johnson. You then led the turnaround at Ipris Biopharmaceuticals, which was a company that was backed by TPG, a big private equity firm. At the time, it looked like a good story with the right approach, but it filed for bankruptcy 4 years later. What do you think happened with the story of Ipris?
Yeah, we had an interesting journey there. We took over the company, and within about 3 months, we found that the founders had committed essentially fraud, about $20 million worth of fraud. So we had a lot of cleanup to do. We stripped the company down to 3 people, and and 9 months later, we took the company public. We had an interesting business model, which now in hindsight, I can critique my own business model. The company was focused on biosimilars, which are generic versions of biologic drugs. Biologic drugs are notoriously difficult to make, and the pathways to get those generic versions of biotechnology drugs, biologic drugs, to the market was far more robust outside the United States than inside the United States. And even today, these biosimilars have done better outside the U.S. than in the U.S. And so our business model was really focused outside the United States, and it was a very interesting and I'd say ahead of its time business model, where we were going to transfer manufacturing to local countries. So as an example, we had won a tender in Brazil, and we were going to do a tech transfer to help Brazil make their own biotech drugs in Brazil. We call that in market for market. And interestingly, speaking of Moderna, they recently teamed up with the same company we had teamed up with to transfer vaccine manufacturing in market for market. So here we are, how many ever years later, and that model still seems to perpetuate. The challenge that we didn't fully recognize is how to convince U.S. investors to support a model like that. And it's very hard for a U.S. investor to diligence a tender in Brazil, or diligence a collaboration with the Saudi government to help build biomanufacturing in Saudi Arabia. And back then, there weren't the large pockets of money in the Middle East that were being deployed to biotech. So if I had to kind of step back and say, what could we have done differently? I would have said we should have spent much more time thinking about non-US sources of capital, and frankly probably shouldn't have gone public, because once we went public we were beholden to the US capital markets, and we were talking to the usual players, and we didn't fit their pattern recognition. um, so eventually we had a European player who acquired the assets of the company, um, and is still making biosimilar drugs in Europe, using the technologies we sold them. We sold them our research and development platform in the Netherlands. Um, so even that less than happy outcome has a very happy ending, which is some of those products have come to market or are actually coming to market. And at the end of the day, that's why we do what we do, is to make sure these drugs can get to market. So, um, but I think I would have probably stayed private longer, and I would have looked for non-conventional sources of capital. Um, that kind of, yeah, we went to Malaysia. We worked with MTDC in Malaysia and NTEC in Kuwait, and but this idea of everyone kind of liked the idea, but there was no receptor on the other side, right? So you walked into these markets and you talked to government officials and deputy health ministers, and you said, we'd like to help you set up your own biomanufacturing capabilities so you can make your own biotech drugs. Great idea, but they didn't have the management on that side. So it's sort of a second key learning, right? So you can't force something on, and even if it's a great idea, if there's not a good receptor on the other side, it becomes very, very difficult. So, it's lots of great lessons learned um, through that journey, and it's really a matching the right capital to the right story. And not every story has the same kind of capital requirements, and not every story is going to resonate with kind of, I'll call it, conventional U.S. biotech investors. Um, so I think that's the lessons learned from that. Never want to point the fingers at situations and circumstances. I always want to take away lessons learned. Um, and the lesson learned here was I needed to be more bold in thinking through the capital structure and thinking through how we built the company. And it was one of the biggest lessons I took from Epirus to Arena, which is you can't incremental your way through a turnaround situation. Um, it takes kind of big, bold thinking. Um, it takes You got to take a razor blade, sometimes a hatchet, to the whole idea, and rethink it from the ground up. And I don't think we did enough of that at Epirus.
Yes, it was your first and probably only bankruptcy that you had to deal with. Do you recall how you felt at the time?
Absolutely depressed, and depressed. I knew the technologies because we did the asset sale. We knew that the assets would get to market, and we knew that the European buyer would do a great job with the infrastructure we sold them, the R&D organization. Um, but I really felt bad for the people, and that's what gave me the sleepless nights. Right, when you go into biotech. Um, the employees of a biotech company, the leadership of a biotech company, we don't have a portfolio effect. We're not investors. We're not in 40, 50 companies. You're really throwing your body in front of the train, in a very high risk endeavor. So I always feel my number one obligation is to the team and the people, um, and letting them down was the hard part.
To continue listening to this episode, please visit thefounderspirit.com or search for The Founder Spirit on Apple, Spotify, or Google Podcasts. Thanks for tuning in. I'm your host, Jennifer Wu.